Let's discuss a very popular strategy to play options, the debit spreads. Recall that a while back I was mentioning the pitfalls of buying options straight, and I had provided some alternatives to buying options. And one of them is debit spreads. Debit spreads are particularly very good strategy during low IV. IV is nothing but a fancy term for understanding fear. When fear is low, the fear insurance is low. How do you build a debit spread? So buy a call that is near to add the money, and then to reduce the cost of buying that call, you sell a call little away from the money. The total outlay for this trade is $23, and what is the width of the spread is $3. In a debit spread, call debit spread, when the market goes up, when the underlying goes up, you make money. The maximum you can make is the difference between 128 minus 125, which is about $3. And on the $3, you already paid $23. So the remaining $3 minus $23 is what you are going to make as a maximum profit. And looking at it, this is how it is. The position that I bought, which is green, is a 50 delta for $2.09, but I didn't pay $2.09. I sold a call 30 delta, which is about 70 OTM, for 89 cents. So my net cost is only $23. So max loss is $23, which I already paid $123, and maximum gain is $377. If you look at in TOS platform, the Thinkorswim, you can see the low IV environment that we are in. So basically 10.56 is the IV, and the expected move for July is plus or minus $3.75. Anything that's below 15 is considered as low, and 10 is really low IV. It's better to go with the debit spread, or I would say debit spread is a fairly good strategy. The most important reason why I took that decision is because of the daily chart 200-day moving average. The stock, after a long time, pierced the 200-day moving average, had a small drop, and then it survived the 200-day moving average. Whenever the stock is around leading moving averages, the large funds get interested. So when it goes above 200-day moving average and sustains there, then a lot of money comes into the 200-day moving average and it pushes the stock further up. Similarly, if it is piercing below 200-day moving averages, all the large funds start selling it. And now adding to it, I'm looking at 20-day 1 hour chart of the mountains, and I notice that right below it's 125.5, and you have a good amount of resistance right around this point. So the moving averages are convincing me to go long, and there is a fairly good floor. Yeah, so this is not a very convincing chart, but look at this, the monkey bars, which is very convincing. If you look at it, it is on this is on 10 days 30 minutes, 20 days 1 hour. Look at it, like the point of control keeps jumping. Here it's jumping, and it does have a big gap. It survived that gap, and I'm reducing the time frame to 10 day 30 minutes. You see there is a poor high everywhere. There is a poor high here, there's a poor high here, and there is a poor high today. So higher prices are ahead, and there is actually today also there's a small gap. But as I was mentioning earlier, 3 out of the 4 quadrants are convincing me that this is a good trade. I do not know if this trade is going to be successful or not, but the reasoning behind my trade is what I want you to look at. When do I close? That does not change. Usually when I open for 45 days, I close it around 21 days to expiration or 50% of the max profit. If you look at it, this is another view from Tastyworks Dove platform where it is a very low IV. Thank you and join me for the rest of my videos.